Today I'm going to be talking about 3 companies that I'm buying right now that I think have the potential for huge gains. The first company is RioCan, which is a real estate investment trust. And if you don't know what that is, REITs or real estate investment trusts are basically companies that invest in real estate, and they have to pay out 90% of their revenue in the form of dividends to shareholders for tax purposes. So as you can see, RioCan is sporting a very high dividend, a 10% yield right now, over $1 a share. And while a 10% dividend would normally be cause for alarm, I'm going to explain to you why I'm not worried at all, and this dividend is completely safe and reliable. As you can see, RioCan has been beaten down since the beginning of the pandemic. It's trading at half of what it was prior to the pandemic. While not a whole lot has changed, their fundamentals remain the same. And if anything, they're coming out of this pandemic stronger than they were before. They're better diversified. They're moving to residential property. If you're familiar with the company Realty Income, ticker symbol O, it's basically a carbon copy of RioCan, except RioCan is the Canadian version. RioCan is trading at a very low PE ratio right now of 8.12, and I think it has the potential to get back to where it was a year ago. You'll see it climb back into that $20 to $25 range. So you have the potential to double your money, and in the meantime, you're collecting a 10% dividend. That's matching essentially a total stock market return annually. Plus, the other great thing I love about this REIT specifically is that they pay their dividend monthly. So while you're not getting 10% every month, it's still annual, but you can divide that 10% out by 12 and you're getting paid every month. So you have steady cash flow that you can rely on. Let me get to why I think this company is very safe and has a lot of potential. If we look at their most recent earnings report, you see they do have a lot of exposure to retail, which they are moving away from. As you can see, they're increasing their mixed use assets, which I'll explain what that is in a minute. So this is management coming out and saying, this is a highly compelling investment opportunity. There's a current negative sentiment that is going to shift when this health crisis dissipates. And as you can see from this chart, they have a dislocated trading price, and it represents tremendous value in RioCan units. Hello, people, they are giving this one away. Nothing has changed here. RioCan is back up to almost collecting as much rent as they were prior to the pandemic, and yet the stock is trading at half the price. This deal, I don't know how much longer it's going to be around for, but I'm buying as much as I can. In the quarter prior, Q1, I believe it was only around 84% of rent collection. People were scared it was going to get worse. They wouldn't be able to pay the dividend. But as you can see, Q2 is up to 91%, and now in Q3, it's up to 94%. That is great in the midst of a pandemic that they're getting 94% of their rent still. They have plenty of money to cover the dividend, and they are expanding into some very exciting properties. So the whole idea behind these mixed-use properties that they're mainly residential, and then they'll have a bottom floor that's retail stores, which works out great, allows them to further diversify. These are in great locations in popular population-dense areas. As you can see here, they offer high-quality rental residences. So they just built these new structures. They had 466 units, and they're 92% are leased already, 228 unit, 100% lease. Here's some of their other projects. Very exciting things happening here. I really don't think you can go wrong with this company. It's one of my favorites, and I'm trying, as I said, I'm getting as much as I can while it's so cheap. So the second company we've got is ARK Innovation. It is an ETF, ticker symbol ARKK. I made a video on the top 10 holdings of this company a while back, which I'll link in the description below. As you can see, ARK has been doing pretty good. I think you'd be pretty content having owned this for the last couple of years. It's got a year-to-date return of 81%. 2017 made 87%. If you put together the last 4 years, this thing has basically tripled your money. It's far outperformed the market. It's not even close. What I like about ARK, they're investing in companies of the future. So far, their philosophy has been working out very well for them. I think that they're really onto something here. If we look at some of their holdings, as I said, I made a video on this already, so I'm not going to take too much time, but Tesla, Invitae, Square, Roku, these are companies of the future. These are going to keep growing. These are companies that are in expansion mode right now. And if we look at a full list of their 50 holdings, I believe they have, you'll probably see a lot of familiar names, and then also some that you've never heard of. But so if we look here, so Tesla, Invitae, Square, those are the 3 biggest holdings. Roku, CRISPR, Teladoc. Now that's interesting. Teladoc is up to their number 6 holding. I've briefly looked into these telehealth companies and this is the importance of getting the information directly from the source, because Yahoo Finance isn't completely up to date. As you can see, Teladoc is their 6th biggest holding. This is why I like to go directly from the source. So I think the future of telemedicine is bright. That's definitely a popular industry that will expand. But instead of buying Teladoc, and you don't know which company is going to do the best, here you buy ARC, you can get a little over 3% exposure to it and own a ton of these other great companies. 2U, LendingTree, Zillow. These are all companies you've probably heard of. There's also a lot you haven't heard of, I'm sure. I was not familiar with many of these companies at first. There's also Pinterest, Zoom, Facebook, Nintendo. Now it's very interesting. Illumina is actually down to their 49th biggest holding. This one used to be in the top 5 or 6. I have to look into what happened there, why they changed their plan with Illumina. If you know anything about Illumina and why it's no longer in the top 10, let me know in the comments below. Definitely have to look into that because it was a promising company. I'm curious if something has changed and why they don't believe in it anymore. I know that it hasn't been a profitable company. It's been growing, it's been doing well, but as you can see here, it looks like their margins are starting to decline according to this first article. Definitely have to look more into that. So yeah, ARC Innovation ETF, and it's got a low expense ratio relatively. I think it's around 0.85. So this company, I think you really can't go wrong with ARC and Cathie Wood. The third company I have that I'm currently buying is Facebook. Now I think of all the FAMGA stocks, Facebook, Microsoft, these are probably they're all pretty expensive right now, but these are the ones I would pick. They're the most cheaply valued, I believe. PE is around 30. And the craziest part about Facebook, it's up today. Obviously, we're going to have a lot of volatility with the election and everything going on, but Facebook smashed their earnings. I'm going to pull up their earnings report here. They had a very, very good quarter. For a company as big as Facebook to be growing at the rate you'll see here is just incredible. So if we look at their Q3 earnings report here, their advertising revenue was up 22% year over year. 22% increase, just incredible in the midst of a pandemic. And you probably remember the big Facebook advertising boycott that was going on. So when you account for these things, you take away that advertising boycott, which was very short-lived, and this number will be even higher, probably closer to 30%, maybe even 40%. But the fact that they grew 22% with everything going on is amazing. This company just keeps growing. There's a big Facebook ecosystem of other companies they own, which I'll get to in a minute. I think they're going in the right direction. They're expanding. They have Facebook Marketplace now, which I'll touch on. I think that's great. They've got things like Shopify now in the pandemic economy, and even moving forward, there's a reason Shopify has grown as much as it has. Shopify does a lot of their advertising on Facebook, so this bodes well for Facebook's advertising revenue as well. If you're not familiar with Shopify, it's a commerce company. They provide a commerce platform for small and medium-sized businesses in Canada, the US, and a couple other countries. It's a Canadian company. Been doing great, and when they're doing great, they're doing a lot of advertising on Facebook. Facebook will prosper as well. Take a look at some of the companies Facebook owns here, which you may or may not know, but it's very interesting. It shows they have some diversity and they're continuing to diversify further. So Facebook owns all of these companies. They own obviously Facebook, Messenger. They also own WhatsApp. This is a very popular app that's growing, and it helps Facebook diversify. Another cool thing about Facebook and their business model is, they also own Instagram, is that they bring these things out and they make it very, useful for people. They get them hooked, and then they figure out how to monetize it later. Their initial goal is not to monetize. They just want to make it the best app that they could be, that's useful to people, and they figure out how to make it profitable later. This was an issue Facebook had early on after it IPO'd. People were worried, how are they going to make money? They're not making any money. Well, it doesn't matter. If you're growing between all the data that they have and more people using your platform, the monetization will come later when they're ready to monetize at the right time and get the most bang for their buck. Another cool thing, Facebook's Marketplace has really started to take off. And again, it all ties into, the pandemic economy, the stuff with Shopify. I've sold a ton of stuff on Facebook, and coming from a person who historically has done a lot of selling on eBay, and they're just atrocious. eBay, they've taken outrageous fees. It's always something aggravating with eBay. They always side with the buyer and not the seller. It's just a headache. And Facebook, I've had a great experience with so far. The fees are much lower. There's actually no fees right now unless you can now ship your items through Facebook, at which point they'll take a very small cut. you're taking home a lot more profit than you were through eBay, where I think fees I was probably paying, plus shipping, we're talking 15-20% of your profit is going to eBay. So I think Facebook Marketplace is going to continue to grow in popularity and overtake eBay. Thank God. It should be FeeBay. These are the main segments of Facebook. They also have a lot of other exciting things underway, like Oculus, with their dabbling in virtual reality. This is a winner. This is a company that I'm going to buy and hold for the long term. So those are the three companies I'm buying. RioCan, it's got a lot of room to grow back to where it was, I think. And as you can see, you're getting this 10% dividend. That's matching market returns. It's not going anywhere. So at worst, I see this as a place to park my money, get this crazy yield. Every month I'm getting cash flow from it. I think it's got immense potential. Real estate is not going anywhere, and especially the fact that they're diversifying further and moving more toward residential and away from retail, I think is great for them and for shareholders. ARC, I think, is a fantastic company, and obviously, I think these are the companies of the future that they own. And when you see Tesla, Square, these companies trading at these insane valuations, Tesla around 400, Square at 150. ARC is a great alternative where you can buy a piece of them and also diversify for $92 a share. Expense ratio is pretty low at 0.75%. Then you get to own a big chunk of Tesla, Square, but also 48 other fantastic companies. Much less risk, and I think this will continue to do very well. And with Facebook, I don't see this company going anywhere. And Facebook and FAMGA as a whole has been under intense regulatory scrutiny and from the government. Talking about getting broken up. I don't think they're going to get broken up, but even if they did, this would be great for shareholders because now you'd own multiple great companies. They're all going to continue to prosper. I think Facebook's a company that's going to be around for a long time, and I see these as buying opportunities. When it dips, when there's controversy and they're under investigation, those dips are the times that I want to buy as much as I can because I think this company is going to continue to do great. So that's all for today. Let me know what you think of these companies in the comments below, and let me know what you want to see videos on in the future. What other companies are you interested in? That's all for today, folks. This is Vinny from the Investment Club, and I'll see you next time.